Welcome to the deep dive. Today, we're zooming in on a number that, well, it might make you scratch your head a bit. Chevron's reported earnings for the second quarter of 2025. They came in at $2.5 billion.
Yeah, and that's noticeably down from $4.4 billion just a year ago.
Exactly. It's certainly a headline figure that could raise some eyebrows,
Wow.
especially for an energy giant like Chevron.
It absolutely could.
So, our mission for this deep dive is to look beyond just that initial number. We're going to unpack the full story of Chevron Corporation's Q2 2025 financials and their strategic developments. What does this quarter really tell us about one of the world's biggest integrated energy companies?
And just so you know, we're basing our entire analysis today on Chevron's official news release that came out August 1st, 2025. It's pretty detailed.
Right.
We'll pull out the most important nuggets, look for those surprising facts, and, connect the dots for you, our listener, so you can walk away really understanding what's going on.
Okay, let's jump right into those earnings then. On the surface, $2.5 billion reported, down from $4.4 billion. It sounds like a pretty rough quarter for Chevron. What's the immediate takeaway, and maybe what's the nuance the headline misses?
Well, what's interesting here is that while those reported earnings were definitely lower, Chevron also highlighted an adjusted earnings figure. For Q2 2025, that was $3.1 billion. Now, that's still down from $4.7 billion a year ago, but it does present a slightly different angle.
So why the adjustment? What does that tell us?
This adjusted earnings number is really crucial because it filters out significant non-operational items, things that aren't part of day-to-day business.
Right.
So it gives us a clearer picture of the company's core business performance, separate from, one-off financial events or accounting things.
Okay, so let's unpack that then. If we're looking past the headline, what were the specific things that pulled down those reported earnings? It sounds like there's more going on than just, say, the oil market.
Oh, absolutely. The news release details several key drivers. The main culprits were, lower crude oil prices, that's one factor for sure, but also reduced income from what they call upstream and downstream equity affiliates.
Okay, what are those exactly?
These are basically companies where Chevron holds a significant stake, but not, full control, so their profits contribute to Chevron's earnings based on that ownership percentage. If those affiliates make less money, Chevron reports less income.
Got it.
We also saw an unfavorable fair value adjustment related to their Hess Corporation shares. Now, that's essentially a non-cash accounting adjustment. It reflects a change in the market value of their investment, not really a direct operational loss.
So paper value changing.
Exactly. And alongside that, there were some pension curtailment costs. Those are kind of one-time expenses from changes to their employee pension plans.
That's a lot of moving parts financially.
Yeah.
I also saw they mentioned a gain from selling some pipeline assets, some non-operated U.S. pipelines. That helped a bit.
It did. It offset some of those negative factors. But then a significant $348 million hit came purely from foreign currency effects.
Wow. Okay.
Yeah, and understanding these specific adjustments, like the currency impact, is really vital for a complete picture. That $348 million isn't just a number. It highlights how vulnerable even huge companies like Chevron are to global economic shifts. Things often outside their direct control, but they hit the bottom line.
Right. Now, here's where it gets really interesting for me, because despite that dip in the reported earnings we just talked about, Chevron's chairman and CEO, Mike Wirth, he said, and I quote, "Second quarter results reflect continued strong execution, record production, and exceptional cash generation." That sounds almost like a contradiction.
Yeah.
How do we square those two things? Lower earnings, but record production and great cash flow.
It absolutely looks contradictory on the surface, doesn't it? And this is where, our deep dive really pays off. The record production he mentioned, that's a huge operational win. Both Chevron's worldwide and U.S. net oil equivalent production actually set new company records in Q2 2025. So they're pumping more than ever.
And when we talk specifics, it's not just a general increase, is it? I think I saw their Permian Basin operations. That's a huge area for them in the U.S. Hit 1 million barrels of oil equivalent per day.
That's right. A specific milestone for that region, a real powerhouse.
Wow.
And Worldwide, production was up quite significantly from a year ago. We saw growth at their Tengishев Royal affiliate TCO in Kazakhstan. That soared by 34%.
34%?
Yeah. The Gulf of America was up 22%, and the Permian itself, as you said, up 14%. This really strong growth more than offset any impacts from selling off other assets. It showcases, really powerful performance in their core production zones.
That kind of operational strength is massive. Okay, and then there's the other part of his quote, exceptional cash generation. What about that?
Right. So cash flow from operations was $8.6 billion in Q2 2025. That's significantly up from $6.3 billion in Q2 2024.
Big jump.
A very big jump. And the report even called it one of the highest in company history when you look at similar commodity price levels.
So what does that mean for the company, practically speaking? Strong cash flow versus those earnings numbers.
Well, this is a critical point. While reported earnings can bounce around because of accounting rules, fair value adjustments, things like that, strong cash flow from operations tells you the company is generating real, actual money from its daily business.
Right, the actual cash coming in the door.
Exactly. That $8.6 billion figure, especially given where commodity prices were, shows Chevron's running efficiently. And high cash flow gives them incredible flexibility. They can use it for future investments, paying down debt, and, importantly, returning cash to shareholders. It kind of insulates them from some of those non-cash earnings hits we discussed.
Okay, that makes sense. So beyond the quarterly numbers, Chevron's clearly been making some big strategic plays. What long-term moves did they make during Q2 or just after that are really shaping the company for, say, the next decade?
Yeah, this is where we see Chevron not just, reacting to the market, but actively trying to position itself for the future. The biggest move, arguably, was completing the Hess Corporation acquisition in July.
Right, that finally closed.
It did. And that followed a favorable arbitration outcome about Hess's offshore Guyana asset, which was a really key part of that whole deal.
Huge potential there, I understand.
Massive potential. This isn't just about getting bigger. It strategically places Chevron in some of the lowest cost, highest return, deep water areas globally. That helps protect them a bit from future oil price swings that might hurt smaller projects.
Okay.
Chevron says it creates one of the most advantaged and differentiated portfolios in the industry. High-quality stuff in Guyana, the U.S. Bakken Shale, and the Gulf of America.
So that's a massive traditional energy play, exactly what you'd expect from a company like Chevron, doubling down on oil and gas.
It is.
But then you see these other moves that seem, well, less expected, like their entry into the U.S. lithium sector, acquiring about 125,000 acres in the Smackover Formation for direct lithium extraction. That's fascinating for an oil major.
It absolutely is, and it definitely signals a broader shift, or at least a broadening of focus. The Smackover Formation is this geological area known for its unique brines. They're really rich in lithium, and it's ideal for this newer, hopefully more environmentally friendly technology called direct lithium extraction, or DLE.
Okay.
And beyond that, they also started production from their Geismar renewable diesel plant in Louisiana. And they didn't just start it, they significantly boosted its capacity from 7,000 barrels per day up to 22,000.
Wow, tripled it, basically.
Pretty much. And they also locked in long-term contracts for liquefied natural gas, LNG. That brings their total U.S. Gulf Coast LNG offtake capacity, how much they can export, to 7 million tons per year, strengthening their global gas business.
And they haven't stopped exploring for traditional oil either, right? They won bids on 9 blocks in Brazil and 2 in Egypt for offshore licenses.
Correct. Still very active on the exploration front, too.
So what does this all mean? When you put these diverse investments together, the huge Hess oil deal, lithium, renewable diesel, LNG, new exploration, how does it all fit with Chevron's stated belief that affordable, reliable, and ever cleaner energy is essential to enabling human progress, and their aim to grow new businesses? It feels like they're pulling in multiple directions.
Well, that really gets to the heart of their strategy, I think. These initiatives clearly show Chevron trying to balance traditional energy growth like Hess and the new exploration with preparing for the energy transition.
Okay.
They're growing their core oil and gas business, which still provides the vast majority of the world's energy and their profits, while simultaneously investing in these other areas like renewable fuels and even lithium, which is obviously critical for batteries and electrification.
So diversification.
Exactly. It seems to be about diversifying their portfolio to meet what they see as evolving energy demands and trying to achieve those long-term goals they talk about in a world that's definitely changing.
Okay, let's maybe break down the performance by segment then. What do the upstream, that's the exploration and production side, and downstream refining and marketing results tell us specifically?
Sure. So in U.S. upstream, their earnings were lower. That was primarily due to lower liquids realizations.
Meaning the price they actually got for their oil and gas liquids.
Precisely. The average price they received was lower than before. But, and this is important, their production volumes were actually up, driven by those strong Permian Basin and Gulf of America assets we mentioned.
So producing more, but getting paid less per barrel, essentially.
That's a good way to put it. And international upstream earnings were also lower. That was partly due to lower earnings from affiliates like TCO in Kazakhstan, even though TCO's sales volumes were higher after a big project started up there.
Okay, so even with some positive production stories, pricing and maybe affiliate earnings were a headwind for the upstream segment overall. What about downstream? Refining and selling fuels, was that a brighter spot?
Yes, downstream was definitely a stronger performer this quarter. U.S. downstream earnings were higher, mainly thanks to better margins on refined product sales, gasoline, diesel, jet fuel, and also lower operating expenses.
Okay.
And their refinery crude unit inputs, basically how much crude oil they actually processed, increased by a significant 17%.
Why was that up so much?
A few reasons. Better operational availability at their El Segundo refinery in California, no major maintenance shutdown like they had last year at Pascagoula, Mississippi, and increased capacity at their Pasadena, Texas refinery. So the machines were running better and harder.
Got it. More throughput.
Right. And refined product sales were also up 4%, mainly due to higher demand for jet fuel and gasoline. International downstream saw higher earnings too, also because of better margins.
So what really stands out to you in these segment results? Especially thinking about what drives profits in each area. It seems like downstream really flexed its operational muscles this quarter.
I think what stands out is exactly that. The company's ability to drive profitability through operational efficiency and being really responsive to market demand in the downstream segment. Even while the upstream side faced those headwinds from commodity prices and specific affiliate issues. And this kind of operational strength allows them to maintain that strong commitment to shareholders we touched on earlier. That continued, no question. Chevron returned $5.5 billion in cash to shareholders during the quarter.
$5.5 billion.
Yep, marking 13 straight quarters where they've returned over $5 billion. That included $2.6 billion buying back their own stock and $2.9 million paid out in dividends.
And they kept the dividend going.
They did, declared a quarterly dividend of $1.71 per share. And critically, tying back to our earlier point, the company's free cash flow. That's the cash from operations minus their capital spending.
The money left over after investments.
Exactly. That was $4.9 billion for the quarter, significantly up from $2.3 billion a year ago. That really underscores their financial strength, even with the lower reported earnings headline.
Okay, so to sort of wrap up our deep dive into Chevron's Q2 2025, the headline number, reported earnings, was down, no doubt. But digging deeper reveals really strong operational performance, record production, exceptional cash flow.
Right. And at the same time, they're making these huge strategic investments, obviously the Hess acquisition, but also these really interesting moves into emerging areas like lithium and boosting renewable fuels.
It's definitely a quarter that highlights this complex, ongoing balancing act for a global energy giant trying to navigate, these evolving energy landscapes.
Very much so.
So maybe a final thought to leave our listeners with. Given Chevron's stated mission providing affordable, reliable, and ever cleaner energy, and their clear continued growth in traditional oil and gas alongside these new, maybe greener ventures, how will they really balance these potentially competing priorities in the years ahead?
That's the multi-billion-dollar question, isn't it?
It really is. What do you think might be the biggest challenge for Chevron as it navigates both growing its core, very profitable fossil fuel business and expanding into the energy transition? And maybe, how might that challenge impact their ability to keep providing what they call human energy to a world that is definitely changing?